Guys, next 20 minutes or so, I want to talk about volatility. Now, we've done a lot of, content over the years on volatility. And I remember in the month of June, we actually did a couple of different coaches shows just on volatility trading. This week, we'll be discussing volatility in earnings. Next week, we'll also discuss volatility in earnings. And I want you to type in the chat the word Vega, okay? Vega. In terms of the family of traders, we think of volatility trading as a Vega strategy. And what I want to do here tonight, Noah, and I think it's, kind of a challenge, it's such a big topic. I don't want to do too many. We did the straddle in June, which I like as a volatility build strategy. So I'm going to let you and Gino pick. Would you guys want to build a call ratio back spread or a straddle?
Depends on if I have a directional bias. If I have a directional bias on a candidate, I like to do those ratio back spreads. If I don't have a directional bias, then straddle or a strangle, something like that. A little bit more neutral direction-wise. It can also be extremely effective. But the key is identifying that if you're going to do those strategies, you have to identify that the volatility is low. When we say shopping around, you want to find something that has low volatility with a reasonable expectation that the volatility will increase as their earnings date approaches. And you usually want to try and catch them, 3-4 weeks before that earnings announcement, if not more, 6 weeks. So that you have time for that volatility to build up to and take advantage of that rise in volatility. In my opinion, it's probably the second easiest thing to predict in the marketplace. Direction harder to predict. Time's the easiest thing to predict because we know it's going to pass. And then the second thing easiest thing is that volatility cycle around earnings. Every 3 months or so, you'll see a volatility increase on stocks that have that personality. And it kind of works like clockwork or calendar work, I guess, if you look at it like that. But it definitely gives you that opportunity to buy options while they're cheaper and have those premiums inflate as the expectation of earnings being able to move the price causes the premiums to rise.
Mm-hmm. Yeah, 100%. I mean, take an example from the Tackle 25, which is a watch list I use quite often. Pull up ABX, which is Barrick Gold. Barrick Gold's an individual company, gold miner, Tackle 25 stock. Now, guys, there's a couple of tips here that I would give you that we need to make sure we understand. You got to be able to look up the earnings date, okay? And even though you can do this online, in my opinion, the best way to look up the earnings date is to do it from a think or swim chart. So you've got historical volatility and implied volatility there. And then we also have our chart offset to the right on the chart. Noah, just so that if anybody has not been trained on how to do that, will you click on the style settings and show where we expand that window on the right real quick?
Yeah, there's a couple places you can do it. You can go to Style, come down to the chart settings. You want to go down to chart settings. And then you're looking for that price time axis, and you want to click on that time axis and go find that expansion area bars to the right. Down here at the bottom of the screen, you see this little two-way arrow down here. Let me point to that. Mm-hmm. So down here, right there, you can click on that, and that will give you a quick pop-up, and you can just reset manual expansion. It'll pop that open and give you, you can actually go in and change a right expansion setting, however many bars you want. I typically recommend at least 30. That'll put you, so you can kind of visualize at least a month out. Earnings, sometimes you need to go out 60 days, or so to see it. But you want enough, there's two reasons I want to see that. One, so I can see future events like earnings, but I also want to be able to think forward. When I'm, picturing a chart, I want to be able to think about what's coming next. Like, can I imagine the price rising? Can I imagine the price, falling down? We can picture and imagine what the trend's going to do.
Yeah, I love it. And by the way, I love having the historical and implied volatility graphs on the bottom. But I think from a training perspective, why don't we keep it simple at first? Just do the implied volatility and kind of let people look at the build in the fall. So guys, what volatility is going to measure is historical or implied. Your options classes, your options theory blogs will explain that. But essentially this blue line down here, when it's at the bottom of the graph, the options are cheap, okay? So in the chat, type in low volatility equals cheap options. Let's make sure we understand that. Low volatility equals cheap options. Now, when you're buying something, you want to get good value, right? You want to get undervalued options. And we like to do this. We tend to trade our volatility build strategies about 4 to 6 weeks for earnings. And I'll just ask you guys, does that blue line look low or high? What do you see? Definitely low. Which, when it's low and it's got earnings about 6 weeks in advance, it generally will start to build in anticipation of that earnings. So what we would do is we would use a positive Vega strategy. Type that in the chat. Positive Vega strategy. IVR is definitely handy here, Josh. That's a good point. Noah, build me a straddle on ABX and kind of walk me through. Let's do, just standard rules here. 2 months plus pay, probably that 3-month option. It's like the 115 would work. December or January would fit the rules. And let's do at the money options. We got 1642. Gino, I'm going to bring you in here. When the stock price is pinned between 2 strikes, because the stock is at 16.42, how do we pick which strikes to play for the straddle?
Which strikes to play for the straddle? It's at where 1642. Tim, this might be a strangle for me if I'm looking at those, which is separating the strikes. Looking at that 23 and 27, trying to find one that matches.
Well, you can do the 16 and 17. It would be about the same delta. In the chat, guys, type in equal delta.
Yeah, you see that?
When you're in, Noah, read those deltas out loud for us.
All right, so you got your put side delta at the 16 strike at negative 0.39, and then on the call side, you go look at the delta column here, and if we're looking at the 16 to the 17, you got those two to choose from. And so, 0.60, these two typically will add up if the same strike price, they'll actually work out to 1. Positive 60 plus, negative 39, it doesn't cancel each other out, but they would add up to 1. If this one's 42, I already know that this is about 58, and it's 57 over there. So, this is one where I like Gino, I'd probably look at buying the 16 put and the 17 call to take advantage of, because they have similar deltas, and it would be very, very, very neutral.
That's about
the goal.
Good. I think so. So why don't we buy the 16 put and buy the 17 call?
So that would be
okay. Equal delta. It's a strangle by definition. See, a straddle is when you have the exact same strike prices. A strangle is when you buy a put and a call in equal amounts, but you have different strike prices. And they're almost identical strategies in conception. It's just the execution's a little bit here different, Gino. So here's our strangle. We got 16 put, 17 call option. Now you'll notice here's the risk profile. Now this is very, very important from a big picture perspective. A picture is worth 1,000 words, right? Sage old advice. Guys, if you haven't learned risk profiles and risk graphs, we've got to spend some more time over here. Tell me what you see visually, because if you can understand the picture, you can understand the trade, okay? Tell me what you pick up on visually. It's a slightly wider V, right? A smile, that's right. Okay. Kind of like a boomerang, not sure. It's okay, Ishmael. So Ishmael, look at where the lines point up. Okay. Do they point up in the middle or on the sides? Are they going up to the right and left? Do you see that? See, what that's telling you is that it's profit if it goes to the right and profit if it goes to the left. So you can make money if the stock goes down or up as long as the volatility increases, okay? Just type in volatility build. Here's the reason we're talking about this. If something is predictable in the market, there's a way to make money on it. And this is a strategy that as a trader, we really like them. When volatility is low, buying options, so now if it goes up or down, as long as the volatility builds, we can make a profit. We're really fighting the time decay here, Noah. ABX, there's an interesting one. Let's see if we can pick one more, Noah, for a good straddle candidate. One thing I like about the morning report at Tackle Trading is, Hector puts in the IV rank right in the Tackle 25. AMD would be a potential one. Ambarella, AMBA, has got a low IV rank. Biogen, let's do Biogen. We did Biogen in June as well.
BIO, what's their symbol again?
BIIB.
BIIB.
Now we are 6 weeks from earnings, okay? Now, guys, is the blue line low or high? Okay. Is it in the middle? Now, Noah, what do you think? How would you read that? We're at 25 volatility. On the IV rank, it's at the lower range of where it's been.
Yep, it's on the lower range of its big picture historical. When you look at the big picture implied volatility, you've seen it out here at 47% and down here at 22%. It's sitting at 25, so I'd call that low end.
Yeah, I would agree with that. So if we were going to go in and play some kind of straddle play on Biogen, we would buy a call and buy a put. Type that in. Buy a call and buy a put. Okay, in the chat, everybody write that down. So we follow our playbook rules. The stock is at 317, so we'll do the same thing we just did. We'll strangle this one, which means we'll take a different strike. Buy the 315 put and the 320 call here, Noah. Now the cost to do this one on Biogen is about $3,500. So some stocks, you can play for lower. I think the last one was pretty cheap. I can't remember. I don't even know what the exact price of that last one was.
Like $130.
$130.
Yeah, so cheap stock, cheap. Yep.
Smaller stocks might fit your position sizing when you're new. Bigger stocks if you're running a bigger portfolio, like a Biogen. $35 options down here as we get ready for volatility build is a fantastic way to look at it. Now, the old Debicon, Josh, we'll leave for maybe another conversation. A little late in the day to start bringing up, adding extra legs on it, right? But that is one of Gino's favorite, no question about it. Let's do one more, Noah, and let's see if everybody can pick this out here. From a volatility standpoint, why don't we take a look at U.S. Steel X. I like it, Jasmine. Good pick. Okay, now very good. Now everybody take a look at I love this one. Here's a great example. Everybody say great example. Okay, Jasmine made a great pick. She put X right in there. Okay, very, very good job, Jasmine. Now, Noah, highlight how the blue line would build into the earnings date each time.
Okay, so first thing you do is identify your earnings date, and you look at that implied volatility. And what the tendency is it builds up into that earnings announcement and tends to stay up there. And then after the earnings announcement's over, you'll see it crush or decrease. So here it is, kind of 6 weeks in advance. Implied volatility is low. There comes the earnings, and look, there it goes off. Rises as soon as they've announced it, and then the risk of price movement is over. You can see the stock gapped, but the volatility comes right back down. Stocks don't always gap, but that's why they build that volatility in, is for that particular big move. Now, the stock doesn't always move big on earnings. We got one big move on earnings, but over here, it popped a little bit, but not nearly as much. And so they tend to overprice the options, and that's what that blue line indicates, is the premiums rising, the implied volatility rising right before the announcement, and then drop. It's like clockwork, and we know what's coming up, and we know where we are now, and we know what it's done in the past. So what might be the reasonable expectation of implied volatility heading into that earnings announcement?
It's a great question, guys. What do you think? Do you think volatility will build, or do you think it will stay flat or go down? Up, down, or sideways? You got to pick one. So this is the reason we're talking about the strategy. Anything predictable in market can be traded, okay, including volatility. Type in the word Vega again. Let's make sure that we're all on the same page. We're talking about Vega strategies and how to play these volatility changes. As a veteran trader, I got to tell you, I loved when I learned about volatility. because it gave me another way to play the market, that wasn't dependent on me picking the up and down in a chart. It's a neutral strategy, and now you just come in and follow your rules, right? And it's about just kind of going through that process and learning these strategies. If you got a few ways to trade things, I mean, you're always going to have something you can do in the market. Now here we are, looking at the options. Now Noah, let's go through this point by point. What is the price of the stock? First person to find it, type it in. Okay, so 24.36. So if we're picking strike prices that are closest to that price, we want to have the closest anchor. Would we do 22, 23, 24, 25, 26, or 27? We would do the 24 strike. So then, Noah, you right click, you buy straddle. And guys, I now have a homework assignment for you. I want you to paper trade one straddle. Type that in chat. Paper trade one straddle.